every Wednesday at 40 past the hour, folks. Let's jump over to our man, Teddy Kekstadt. You can check out his outstanding Tiger Forex Report right on the front page of TFNN under the newsletter tab. Check that out. Only $97 a month, folks. You gain access to an outstanding webinar. It comes with a 30-day money-back guarantee. I encourage you. Check it out. Go sign up for it while we're talking to our man, Teddy. Teddy Kekstadt, good morning.
Good morning.
So we got some action, man. We got the dollar oscillating around that 100 price point, a little lower. We got yields rising above the 10-year. I know you like that 30-year, man, above 5%. Maybe that's where we kick it off. What do you want to talk about this morning?
I think that this is a good time to talk about divergence. So we have yields rising and the dollar falling. This is a good indication of how, when you're trading, when you look at fundamentals and technicals, you always have to manage them properly and don't just rely on them as a tried and true mechanism. If it was that easy, everyone would be doing it, right? So, and this is one that goes to show it. Like typically on many days or many intraday moves, you will make a play in a dollar pair, dollar versus whatever other currency based off of yields. You will look at it in that view. Right now, if you're taking that stance using yields as a guide for you, you're losing money. That's for sure. Yeah. So this is where you can't just, it's not as simple as like, oh, yields are up, buy the dollar, yields are down, sell the dollar. That's not that simple. So it's a very interesting thing, but this is also, when you have divergence like this, usually you have divergence like this when you are getting ready to set off a big trend, or what you're doing is you are actually establishing a range trade, because you're having a rubber band effect. No matter what, you're still going to have to come back to some sort of midline between that divergence. The divergence doesn't last forever, otherwise it wouldn't be divergence.
Yeah, right. No, and they're correlated to a certain degree once everything maybe recalibrates. That's how I trade, and I'm glad you're talking about it, because it is interesting, man. That we have yields spiking. And even with a higher yield, nobody is getting dollars to access that higher yield. Now, eventually they will, because that's just how it works, right? That's the relationship. But it's not happening, and it's not happening on days we have the market trading lower. So we have, people essentially pulling money out of the market, and they're not putting it in fixed income or in the dollar. Do you tie that to equities at all? What do you think about equities? I know that yields in dollar, but it's interesting that they're both falling, but it's not going into U.S. equities, at least as we're lower, at least, nothing, but we are lower in the same context right now.
Sure. Okay. So let's pick, what's your favorite oil stock symbol?
Oil stock.
Seriously.
Exxon. Why not? I don't know, right. But why not? We'll go Exxon.
Okay. And that's what's their symbol for Exxon?
XOM. XOM.
XOM, right?
I don't know many symbols. You pulled me out of the oil. CVX or XOM.
Yeah, that's right.
Probably the two oil ones I know. Chevron or XOM, yeah.
Okay, all right. So here's a very interesting thing. You look at XOM. If you look at that chart over the past, say, like month and a half.
Yes.
And then you look at oil. What does that look like?
I'm pulling them up. Yeah, pretty similar, right?
Pretty similar, right? So right now, I would say that with this right now, what you're looking at is that you're seeing that the range trade in oil is starting to set a range trade up in the oil stocks, because there's no trend right now. We're hitting the upper barriers. There's no reason for us to break out to the upside. And there's no real reason for the market to tank right now. Now, what is interesting is like where interest rates right now are diverging from the dollar. One thing they're not diverging from is the real commodities, because since yields are higher, the cost of carry goes up, which means that influences bearish pressure, meaning that bearish pressure will be lighter because interest rate pressure is actually helping to support the price of oil. Now, most people who don't trade oil or commodities don't understand what I'm talking about. Cost to carry is the interest rate that's charged on all those deliverable amounts of oil or any said commodity. Okay, so because usually that's finance. So depending on what the interest rate is, now those are market rates; those aren't bank rates. Okay, so that means since yields are going higher right now, or at least pushing higher, in the short run, that's reflective in oil price, crude oil prices also, because they know that at the current level, everything that's going to market is being financed at that higher level versus what was, say, a month ago, right?
Yeah.
So, and what is that doing to the oil stock? Exxon's going down because what the profit margin is going down right now. Makes sense?
Yeah. Of
so
course,
so anyone who trades Exxon stock, looks for that, thinking like, okay, right now, odds are their earnings are going to be shrinking right now unless crude takes a nice, really big dive. Yeah. So, in which case that would alter that.
Since you're talking about it, and I see that, we bounced to 64. We got that news out that potentially Israel going to strike Iran. Mm-hmm. Nonetheless, it is pretty interesting. Can't even find a bid on that type of news. Not saying that it would spike to the moon, right? But we're sitting at $62. We gave back the entire move. Are we capped in this 64 to 65 range right now, you think, on crude?
I think that right now we're looking at a high of probably 65, 66, and that would be a spike. I don't think it would be sustainable. And I think that the floor right now is probably around 57 to 58. I would like to see it get back down to 52, which I think it could be in a few months, without a doubt. Sure. That's very, very possible, especially if there's a rate cut. And we'll see how the economic numbers are and what's going on with the economy too. Yeah. So the demand for oil may actually decrease into the summer months because a lot of people, they're strapped, so they may not be traveling at all this summer. Which
Target's
means
blaming it all on. I was just say Target's blaming it all on the economy this morning. I'm not sure that's the case, but I think they got some issues, man. Talking about just that a consumer out there, we know it. They're feeling the heat, man, for sure.
Right. Well, you know what? When it costs all the money to go out for to a restaurant right now, if you're on vacation, you're eating out every day, right? Yeah, I think that's the biggest drag. So anyhow,
it is.
Sorry.
No, it's just it takes a while for our to get used to these costs. I think we're still dealing with a recalibration of our brains of how expensive things are. Even though, guess what? That's the case, man. We're there. Hey, what about yields in terms of the 30-year at 5%? I'm hearing a lot of people talking about 5%. Of course, we're 30 years at 5 now. We got the 10-year at 4.5 about. What do you think about these levels of where we are with yield?
Sure. Okay. I think that
because can I add in there that we got the taxes going on, of course, because that's is do you think that's what's lifting yields? I mean, it's so short term, but it is going on right now as we got kind of a little bit of spike with the 30-year above 5. Hey, I tell you what, Teddy.
Yeah.
Can we hang? Can I leave the listeners on a cliff on that one, and we'll come back?
Absolutely.
Can we come back on that one? All right.
We'll talk about rates.
Perfect. We're going to break, folks. We're going to talk about yields, man, as we got the 10-year right now, above 4.5%. The 10-year negative by 10 ticks, as Teddy was talking about, man. You got yields, you got the dollar, we got divergence, and we're going to finish up this conversation when we come back, folks. Don't go away. Welcome back, folks. We got the S&Ps down by 27 points, right where we were at about 8 a.m. this morning, up to those highs. We're talking to our man Teddy Kekstadt. We're talking a little bit of yields. So, Teddy, I know we talked about the divergence with yields in the dollar, but I was just wondering about kind of these price points. Nice even round numbers, the 30-year at 5% and the 10-year at 4.5, and what you think about those levels.
Well, you know what? I have both the 30-year and the 10-year chart up, and I'm looking at them, right now. I think no matter what, you're going to see them both test the lows, meaning you're going to see a little bit of pressure on yields, especially, I would say, for the next couple weeks until we get closer to the next Fed meeting. So I don't think we're going to hit the extreme of where we were in January, just because the expectations of rate cuts has grown by the consensus, if you will. When we started the year off, people were looking for 2 quarter-point cuts over the course of the year. Right now, depending on who you listen to, people are predicting 4 to 5 quarter-point cuts. I think that's an extreme. I really, really don't think that's going to happen because Powell doesn't like Trump, and I don't see him giving him what he wants. And I'm just saying on that level alone, as far as what he should do or shouldn't do, that's a whole other story. But the market is commanding higher yields, and that's the reality, is that people are starting to get used to, getting interest on their money, for one, let alone banks are getting used to charging higher rates. So I mean, we've been trading near zero for so long, people forget that that's not normal. It's just not. So I think that until we really have a rate cut, and even still, the market wants higher yields. I don't see us having any real big reversal of trend, meaning lower trending yields on a big basis, on a multi-month basis, unless you were to see Powell come out and do a 0.5 point cut with the expectation of another 1/4 point coming within the next 1 to 2 meetings. Something like that, then I could see we skyrocket, in bond prices and 10-year note prices. So
I'm not sure we want that. What's the economy look like if that happens, though, right? In terms of where we go. But I agree, man. Recency bias, 20 years almost at 0% coming out of it, man. Teddy, thanks so much for the great conversation as always, man. We'll talk to you next week. Have a great Memorial Day as well, Teddy.
Yep, you too.